Publication 583 of the Internal Revenue Service, Starting a Business and Keeping Records. So, the introduction, this publication provides basic federal tax information for people who are starting a business. It also provides information on keeping records and illustrates a record-keeping system. Throughout this publication, we defer to IRS publications and forums where you find more information. In addition, you may want to contact the government agencies such as the Small Business Administration, and there's a link to a See How to Get Tax Help later in the document. So, for future developments, for the latest information about developments related to this publication, such as legislation enacted after it was published, you can go to www.irs.gov/PUB 583. I'm going to skip the comments and suggestions section because I feel like that's, you can look that up. There's also a section there's a table on what business owners need to know about federal taxes. These are really specific links. We're looking at this for an enrolled agent exam, so I'm going to kind of skip through some of that. And get to the real beginning, which is on page 3, determining which type of business to use. The most common forms of business are the sole proprietorship, partnership, and corporation. When beginning a business, you must decide which form of business to use. Legal and tax considerations enter into this discussion. Only tax considerations are discussed in this publication. The first tip is that your form of business determines which income tax return form you have to file. There's also a table in here, which I'm not going to read tables, but it's table 2. So sole proprietorships. A sole proprietorship is an unincorporated business that is owned by one individual. It is the simplest form of business organization to start and maintain. The business has no existence apart from you, the owner. Its liabilities are your personal liabilities. You undertake the risk of the businesses for all assets owned, whether or not used in the business. You include the income and expenses of the business on your personal tax return. So for more information on sole proprietorships themselves, that's publication 334, which I will go over later as we move through the test. There's also always reminders about farmers and specific jobs in this one. Publication 225 is the Farmer's Tax Guide that relates to sole proprietorships. Partnerships. A partnership is a relationship existing between two or more persons who join to carry on a trade or business. Each person contributes money, property, labor, or skill, and expects to share in profits and losses of the business. A partnership must file an annual information return to report the income, deductions, gains, losses, etc. from its operations. But it does not pay income tax. Instead, it passes through any profits or losses to its partners. Each partner includes his or her share of the partnership's items on his or her tax return. For more information on partnerships, you can see publication 541, which is just entitled Partnerships. Next is businesses owned and operated by spouses. If you and your spouse jointly own and operate an unincorporated business and share in the profits and losses, you are partners in a partnership, whether or not you have a formal partnership agreement. Do not use Schedule C or CEZ. Instead, you file Form 1065, the U.S. Return on Partnerships Income. You can get more information on partnerships specifically from publication 541 again. An exception is community income. If you and your spouse wholly own an unincorporated business as community property under the community property laws of a state, foreign country, or U.S. possession, you can treat the business either as a sole proprietorship or a partnership. The only states with community property laws are Arizona, California, Idaho, Louisiana, Nevada, New Mexico, Texas, Washington, and Wisconsin. Another exception is a qualified joint venture. If you and your spouse each materially participate as the only members of a jointly owned and operated business, and you file a joint return for the tax year, you can make a joint election to be treated as a qualified joint venture instead of a partnership for the tax year. Making this election will allow you to avoid the complexity of Form 1065, but still give each spouse credit for Social Security earnings on which retirement benefits are based. For explanation of material participation, see instructions for Schedule C and its line G. To make this election, you must divide all items of income, gain, loss, deduction, and credit attributable to the business between you and your spouse in accordance with each respective interest in the venture. Each of you must file a separate CZ or CEZ, a separate Schedule C or CEZ, and a separate Schedule SE. For more information, you can see qualified joint venture and the instructions for the Schedule SE. Another option is corporations. In forming a corporation, prospective shareholders exchange money, property, or both for the corporation's capital stock. A corporation generally takes the same deductions as a sole proprietorship to figure its taxable income. A corporation can also take special deductions. A type of corporation is a C corporation. The profit of a C corporation is taxed to the corporation when earned, and then is taxed to the shareholders when distributed as dividends. However, shareholders cannot deduct any loss of the corporation. For more information on corporations, that is publication 542 entitled Corporations. Another option is an S corporation. An eligible domestic corporation or a domestic entity eligible to elect to be treated as a corporation can avoid double taxation, once to the corporation and again to the shareholders as discussed above, as long as it meets certain tests and elects to be treated as an S corporation. Generally, an S corporation is exempt from federal income tax other than tax on certain capital gains and passive income. On their tax returns, the S corporation's shareholders include their share of the corporation's separately stated items of income, deduction, loss, and credit, and their share of non-separately stated income or loss. For more information on S corporations and the tests needed to be met to be eligible to elect to be an S corporation, you see the instructions in Form 2553 entitled Election by a Small Business Corporation, and also Form 1120S entitled United States Tax Return for an S corporation. Another possible type of business is a limited liability company. A limited liability company, or an LLC, is an entity formed under state law by filing articles of organization as an LLC. The members of an LLC are not personally liable for its debts. An LLC may be classified for federal income tax purposes as either a partnership, a corporation, or an entity disregarded as separate from its owner by applying the rules and regulations in Section 301.7701-3. For more information on LLCs, you see the instructions in Form 8832 entitled Entity Classification Election. Now the next step is getting a taxpayer identification number. You must have a taxpayer identification number so the IRS can process your returns. Two of the most common kinds of taxpayer identification numbers are the Social Security numbers and the Employee Identification Number. A Social Security number is issued to individuals by the Social Security Administration and is in the following format, which is 3 numbers, -2 numbers, -4 numbers. An EIN, an Employee Identification Number, is issued to individuals or sole proprietors, partnerships, corporations, and other entities by the IRS and is in the following format: 2 numbers, -7 numbers. Providing your identification number to others. You must include your taxpayer identification number, which is either your Social Security number or your employee identification number, on all returns and other documents you send to the IRS. You must also give your number to other persons who use your identification number on any returns or documents they send to the IRS. This includes returns or documents filed to report the following information: 1. Interest, dividends, royalties, etc. that are paid to you. 2. Any amount paid to you as a dependent care provider. 3. Certain other amounts paid to you that total $600 or more for the year. If you do not furnish your identification number as required, you may be subject to penalties. And you can see penalties later in this selection. An employee identification number, or EIN, EINs are assigned to sole proprietors, LLCs, corporations, and partnerships for tax filing and reporting purposes. See Form SS-4 and its instructions for more information and to see which business must get an EIN. Applying for an EIN. You may apply for an EIN in 3 ways. Online, you click on the Employer ID Numbers link at www.irs.gov/business/small. The EIN is issued immediately once the application information is validated. Or by mailing or faxing Form SS-4, which is an application for Employer Identification Number. Or international applicants may call 267-941-1099, which is not a toll-free number. When to apply. You should apply for an EIN early enough to receive the number by the time you must file a return or statement or make a tax deposit. If you apply by mail, file Form SS-4 at least 4 weeks before you need an EIN. If you apply by telephone or through the IRS website, you can get an EIN immediately. If you apply by fax, you can get an EIN within 4 business days. If you do not receive your EIN by the time a return is due, file your return anyways, write applied for, and the date you applied for, and the number in the space for the EIN. Do not use your Social Security number as a substitute for your EIN on your tax returns. More than one EIN. You should have only one EIN. If you have more than one EIN and are not sure which to use, contact the Internal Revenue Service Center where you file your return. Give the number you have, the name and address to which each was assigned, and the address on your main place of business. The IRS will tell you which number to use. For more information about EINs, you can see publication 1635, Understanding Your EIN. Payee's identification number. In the operation of a business, you will probably make certain payments you must report on information returns, which is also discussed later in a section called Information Returns. The forms used to report these payments must include a payee's identification number. So if it's an employee, if you have employees, you must give a Social Security number form from each of them. Record the name and Social Security number and each employee's exactly as they are shown on the employee's Social Security card. If the employee's name is not correct as shown on the card, the employee should request a new card from the Social Security Administration. This may occur, for example, if the employee's name is changed due to marriage or divorce. If your employee does not have a Social Security number, he or she should file a Form SS-5, which is an application for Social Security card with the Social Security Administration. This form is available at Social Security Administration offices or by calling 1-800-772-1213. It's also available from the Social Security Administration website at www.ssa.gov. Another payee. If you make payments to somebody who is not your employee and you must report the payments on an informational return, get that person's Social Security number. If you make reportable payments to an organization such as a corporation or partnership, you must get its EIN. To get the payee's Social Security number or employee identification number, use Form W-9 entitled Request for Taxpayer Identification Number and Certification. This form is available from IRS offices or by calling 1-800-829-3676. It's also available on the IRS website, which is irs.gov. A caution symbol. If the payee does not provide you with an identification number, you may have to withhold part of the payments as backup withholding. For information on backup withholding, see the Form W-9 instructions and the general instructions for certain information returns. Designating a tax year. You must figure your tax income and file an income tax return based on an annual accounting period called a tax year. Tax year is usually 12 consecutive months. There are 2 kinds of tax years: calendar tax year and the fiscal tax year. A calendar tax year is 12 consecutive months beginning January 1st and ending December 31st. A fiscal tax year is 12 consecutive months ending on the last day of any month except December. A 52-53 week tax year is a fiscal tax year that varies from 52 to 53 weeks but does not have to end on the last day of the month. If you file your first tax return using a calendar tax year, and you later begin a business as a sole proprietor, become a partner in a partnership, or become a shareholder in an S corporation, you must continue to use the calendar year unless you get IRS approval to change it or are otherwise allowed to change it without IRS approval. You must use the calendar tax year if you keep no books, you have no annual accounting period, your present tax year does not qualify as a fiscal year, you are required to use a calendar year by a provision of the IRS code or the income tax regulations. For more information on this, see Publication 538, Accounting Periods and Methods. For first-time filers, if you have never filed an income tax return for your business, you can adopt either a calendar tax year or a fiscal tax year. Although some partnerships and S corporations must use a particular tax year, and you can find out that in Publication 538, you adopt a tax year by filing your first income tax return using that tax year. You have not adopted a tax year if all you did was one or more of the following: filed an application for an extension of time to file an income tax return, filed an application for an employee identification number, or paid estimated taxes for that tax year. Changing your tax year. Once you have adopted your tax year, you may have to get IRS approval to change it. To get approval, you must file Form 1128, application to adopt, change, or retain a tax year. You may have to pay a fee. For more information, see Publication 538. Choosing an accounting method. An accounting method is a set of rules used to determine when and how income and expenses are reported. You choose an accounting method for your business when you file your first income tax return. There are two basic accounting methods: cash method, and accrual method. Under the cash method, you report income in the tax year you receive it. You usually deduct or capitalize expenses in the tax year that you pay them. Under the accrual method, you generally report income in the tax year you earn it, even though you may receive payment later in a later year. You deduct or capitalize expenses in the tax year you incur them, whether or not you pay them that year. For other methods, you can see Publication 538. If an inventory is necessary to account for your income, you must generally use an accrual method of accounting for purchases and sales. Inventories include goods held for sale on a normal course of business. They also include raw materials and supplies that will physically become part of a merchandise intended for sale. Inventories are explained in Publications 538.